Hey, what's going on? Today, I want to share with you guys the BRRRR calculator, which is the calculator I use every time I run numbers and analyze a property to purchase using the BRRRR strategy. It's a great wealth builder. If you're in real estate already, you've probably used this or something very similar. If you're interested in real estate, this is a great tool to get started on just running numbers, seeing how numbers shake out, and what's a good investment compared to what may be a bad investment based purely on numbers. Now, I'm going to go in here with an assumption of knowing a lot of things because it's in the property that I'm going to be analyzing is in a neighborhood that I'm familiar with. So this would be probably step two of the situation. First, I would just verify that they're actually a motivated seller. That's a likely chance of closing. It could be a potentially good deal. And then this would be a second step going into that initial analysis before going into more of a deeper dive analysis and verifying all my numbers are correct. So I'm going to fly through a lot of this. I just want you to know that this is more of the step two, and we would go into a pure fact finding later on. But without further ado, check out the BRRRR calculator. I think you're going to like it. It's very simple and easy to use. Pay 1,200 in property annual tax. Address is not important in this situation. They're wanting 59,000 after repair value. So after the property's fixed up, it's probably worth about 115. We'd have about $2,500 in closing costs on the front end, and I think that repair cost, from just what I see in pictures, is about 35,000. Now I'd go back and verify that as I dive deeper into it, if it passed this first go through, this first check of being a good deal. So, say on the purchase. So this is on the original purchase of the property. We would probably get a private money investor to partner with us on this deal. We paid them 12% interest on the loan. We'd have $0 into it, so we'd want them to fund 100% of the purchase and pay 1%, or excuse me, 1 point to the lender at the beginning. Interest only, and we were refinanced within about 5 months. That's pretty average. And rehab, that means all the work would be done and someone would be ready to move in about 3 months. Okay, so we've done that. We purchased the property, we rehabbed it. We're now got somebody rented in there. What could we go refinance this property for? If I believe that the property is worth 115,000, usually banks will lend out. I'm gonna do a calculator. Usually banks will lend out about 75 to 85% of that after repair value. So we're gonna take 115 times 0.75 is $86,000. So it's reasonable to think that a bank would lend us $86,000 to a stabilized asset after we fix the property up and get a renter in there. And just be on loan amount, or excuse me, interest rate, anywhere from like 6 to 7 right now. I think that my last quote from a lender was 6.25. And of course, we're going to have lending fees at your closing cost, your appraisals, everything of that nature. Amortized over 20, how many years? Most times it's 20. Sometimes you can talk banks into doing 25 years, especially if you have a good relationship with a small bank. All right, then that was okay. So that was I'll go back one step. So that's the purchase of the property, the financing of the purchase of the property, how long that's going to take to rehab and refinance, and then the refinance rate. What's our end after we refinance the property? What's our end loan amount going to be? So information is all here. And then we'll jump to the income section and the expense section, which is our last section of the report that we need to do. I think this thing would rent for about $975 when all said and done. We would not have to pay any of the expenses because it's going to be a single family house. Using single family houses, that tenants pay water, sewer, electricity, everything. One thing we would be responsible for is monthly insurance and also property taxes, which both would shake out to about 100 a piece. Those are two other numbers I would verify before making a hard offer. Um, but from what my experience is, what we're probably going to land at. So you get your vacancy. You always want to bake in vacancy because it's going to happen over time. You may have a good run where someone stays for 2 to 3 years. but eventually they will move out. There will be turnover. You'll have to fix up. You have to do some paint. And there's going to be a downtime, a couple months where no one's going to live in there. So we're going to bake that in. There's going to be repairs and maintenance, even though that the first couple of years it's going to be really low because you're doing all your repairs on the front end with the BRRRR. Eventually, after 4 to 5 years, this stuff starts to break down. Sinks start to leak, toilets start to break that you have to repair. So we're going to go ahead and bake that in because it happens. And then capital expenditures at your roofs, HVACs, your water heaters, your plumbing, your electricity, everything like that. Big capital expenditures are going to pop up. You need to be aware of those and have those calculated. But then we do have management in place that we don't manage ourselves. So we're going to put that in there. Also, annual income growth. We usually raise rents about 2 to 3% per year. Expenses go with that as well. And then on average, I put about 10% for sales expense. If I ever wanted to turn around and sell it in 5 to 6 years, what kind of expenses going to go with that? It's your realtor fees, your closing costs, your fix-up costs, etc. So we'll calculate results from here. And here is where all of our numbers are spit out. And this is where like we actually get some good information to see like, is this a good investment for us? And a couple things I am looking at right off the bat is the monthly cash flow. So it's got a $51 monthly cash flow. It's not outstanding, but anytime that you can get paid to own an asset, it's a good thing. It should be worth looking at. So since it's cash flowing positively, that's great. I would like that to be up 100 plus, usually for my investments. But it is a good start. Maybe we need to dive further in numbers, see if we can shake some stuff around to make that a better number. Cash on cash return, I'm always looking at that. 4%, not great. You could do pretty much better with maybe, I don't know, you can do better just different investments. The thing to know about the cash on cash return is that it's going to be your direct return on investment that you left in the deal with the BRRRR. It doesn't calculate for the equity you create, the appreciation you create over time, the depreciation that you create over time. That's going to make this number very much bigger, like a very larger ROI. But just based on just the cash flow itself, you get about 4% return, which isn't great. I think that you want to be up to closer to 16 to 20% for a great investment. And to go with that, what I'm looking at is that cash on cash return is how much cash is being sunk into this property. And it looks like there's going to be about $15,000 almost left into the property when it's all said and done. So after I go buy it, I use a private investor, fix it up, use all those expenses calculated with holding the property and also fixing the property. When we go to refinance, I'm still going to be left with $15,000 stuck in this deal. And it's going to spit out a 4% return ROI on that cash. That's not great. I think I can do a lot better somewhere else with $15,000 than I can on a 4% return. So that's something I'm looking at, and I'm like, I'm not loving right now on this deal. This is the first time I've looked at this, so you're kind of seeing this live with me at this point. One thing with cash flow is, we're definitely going to have those vacancies in CapEx and repairs. They're going to pop up, but they're not going to pop up every month. So you could almost, the way I picture it is I'm going to have an extra $60 to go with this monthly cash flow going into my bank account, just knowing that here in 6 months, it's going to be depleted for something. But there will be another $60 added as a surplus to your bank account, your monthly cash flow, just knowing that it's an expense that's going to happen eventually. So, I don't really go too far into the purchase cap rates, use more for multifamily, pro forma cap rate, stuff like that. Looking at monthly expenses. So they're saying it's going to have like $923 to run this property on a monthly basis. And if you rent it out for $975, then you're going to make that $51. It's very thin, very, very small margins, not a great deal. What else can we look at? Down here is your analysis over time. See, that's what I was saying about your, right here is what I was talking about on it's going to be a larger number when you calculate for your equity in the property, the difference between what the property's worth divided by what the property is, what you owe on the property. So you're going to build up a good amount of equity over time. You're also going to have depreciation that's not shown on here, but your analyzed return is going to be much higher when you calculate for those numbers. But as far as a cash on cash return immediately on a yearly basis, it's going to be much lower. So you have your 13% loss, cash on cash ROI, and so forth going throughout. So this is something that I would have to play around and see if there's some better numbers I could work with. Maybe I could raise my loan amount up higher. I can negotiate a good deal with the bank to raise that up. But then again, that would hurt my monthly expenses. It would raise my monthly expenses as well. So we might just get creative on this one, see if it's worth. And if it's not worth looking at anymore, then let's move on to the next one and just keep trucking and find the next deal. But hopefully this helps. And if you have any questions about this, let me know, and I will talk to you guys soon.